Hello and welcome to this webinar. This webinar is the third in the Housing Industry Association's series of webinars related to the JobKeeper Payment stimulus measures provided by the federal government in response to COVID-19. This webinar will focus on receiving the JobKeeper Payment. Today we will provide a refresh on what the JobKeeper Payment is and will outline what to be expected when receiving the payment. HIA has developed a series of fact sheets and webinars on the JobKeeper Payment to assist members understand these requirements. We understand the whole process can be complex and would like to remind members that if you need assistance, you can contact HIA Workplace Services on 1300 650 620 or by email at inquiry@hia.com.au. So just a bit of a recap. Becoming eligible for the JobKeeper Payment means two things. Firstly, as an employer, you will be eligible for a wage subsidy of $1,500 before tax per fortnight per employee for up to 6 months. PAYG Withholding is payable on that amount. The payment of superannuation, however, will depend on whether the employee's usual wage is more or less than the $1,500. For more information, please see the HIA info sheet number 4, receiving the payment. Secondly, once eligible, an employer can give eligible employees directions in relation to hours of work and annual leave. These working arrangement directions are explained further in information sheets on our website and other webinars HIA will have available going forward. It's important to remember that the purpose of the JobKeeper Payment is to support employers maintain a connection with their employees, enabling businesses to reactivate their operations quickly without having to rehire staff when the crisis is over. So, when would you receive the first payment? If your business is eligible for the scheme in April, the first payment will be made by 14 May. To cover the first 2 April JobKeeper fortnights, which commenced from the 30th of March. The payments will last for up to 6 months, running from the 30th of March to the 27th of September. The final JobKeeper fortnight period will start on the 14th of September and end on the 27th of September. So, are you required to withhold PAYG? Yes. You are required to pay PAYG withholding on job seeker payments. The $1,500 per fortnight per employee is a before tax amount, and you are required to deduct PAYG from this amount. When an employee is paid more than $1,500 per fortnight, the employer's superannuation obligations will not change. Where an employee is having their wages topped up to $1,500 per fortnight by the JobKeeper Payment, it will be up to the employee as to whether or not they want to pay superannuation. So a little bit of a worked example of when you are required to pay superannuation will depend on whether your employee is still working or if they have been stood down. In the case of an employee who is still working, if your employee is paid more than $1,500 before tax per fortnight or continues to be paid their ordinary wage of $1,500 before tax per fortnight, your superannuation obligations will not change. If your employee's wages are topped up to $1,500 per fortnight before tax, you will be required to maintain superannuation on their ordinary wages. However, where an employee is stood down and not working, and they receive the JobKeeper Payment, superannuation payments will be at your discretion. Once business and employee eligibility has been determined and approved, you must make payments to all eligible employees for all JobKeeper fortnights claimed. This effectively will mean you'll have to pay your employees in advance of your JobKeeper payments being received. The ATO has indicated you have until the 8th of May to make payments to your employees if you have claimed JobKeeper payments for the April periods. The government's advice for employees who may have difficulty in this requirement is that they should contact their bank. Of note, when receiving the JobKeeper payments, your eligible employees can either continue to work at full and normal capacity. This may require you to maintain their ordinary wages and use the JobKeeper payment as a supplement to those wages. They can be stood down from work where there is no meaningful work to keep an employee engaged. This will mean you will pass the JobKeeper payment on in full to maintain their employment during this stand down period, or have the employee work at a reduced capacity. This may mean the employee's hours of work are reduced to meet the equivalent amount of the JobKeeper payment. We will now go through each of these scenarios in terms of receiving the JobKeeper payment. Firstly, if you have an employee working at full or normal capacity, yes, you will be required to continue to pay the employee's full wages. This will mean that despite receiving the JobKeeper payment to supplement your employee's wages, you will still need to pay employees as you would have ordinarily. So let's just go through a little bit of a worked example. So your labourer Joe earns $1,500 per fortnight before tax. This was his wage before the JobKeeper payment was introduced. You receive $1,500 per fortnight from the JobKeeper payment to subsidise Joe's salary. Joe is still working his normal 38 hours per week. Therefore, you continue to pay Joe's full wage, including PAYG and required superannuation based on Joe's normal income. So how does the payment look in practice? Joe is still working at normal capacity and is earning the same wages before JobKeeper was introduced. That's $1,500 per fortnight before tax. The employer therefore pays Joe that amount, takes the appropriate tax of $192, and therefore the employee receives $1,308. The employer is also then required to pay superannuation on the employee's ordinary wages of $1,500, being $142.50. This same principle would apply when an employer receives the JobKeeper payment and the employee is paid more than $1,500. The $1,500 can be used to offset the employer's wages bill, but there would still be an obligation to pay those wages and superannuation as normal. You may have employees who are working reduced hours during the COVID-19 pandemic. This could be for a variety of reasons. In this circumstance, you will not be obligated to pay the employee's full wages, unless, of course, the employee is accessing another form of paid leave during the period of reduced hours. If your employee is working at reduced capacity, you will be required to pay the employee the equivalent wages for hours worked, or the $1,500 JobKeeper payment, whichever is greater. So let's just go through a bit of an example based on reduced working arrangements. Your office manager, Anna, ordinarily works 38 hours per week and earns $2,000 before tax per fortnight. You receive the $1,500 per fortnight JobKeeper payment to subsidise Anna's salary. Anna is working reduced hours of 28 hours per week, which is equivalent to $1,474 per fortnight before tax. Because the JobKeeper payment is more in this scenario, you should pay Anna the full $1,500 per fortnight, including PAYG, plus superannuation based on the $1,474. So how does the payment look in practice? So Anna is working at reduced capacity of 28 hours per week, as opposed to her ordinary 38 hours per week. Her ordinary wage is $2,000 before tax per fortnight. However, because of the reduced hours, she will receive $1,474. Because the JobKeeper payment is more than this, the employer is required to pass on the full $1,500 and top up her wages by $26. The approximate tax will be $192, which will be required to be withheld. Therefore, Anna is paid $1,308. The employer is required to pay superannuation on the employee's ordinary wages of $1,474, being approximately $140. The next scenario is where you may have employees stood down. These are employees who are still employed by your business, however, are not currently working due to there being no useful work available. These employees will receive $1,500 per fortnight before tax. By way of example, Nicole, your contracts administrator, earns $2,000 per fortnight before tax. Nicole has been stood down due to the lack of work. In this case, you will pay the employee the JobKeeper amount of $1,500 per fortnight before tax. You will be required to pay PAYG on this amount, but no superannuation payment is required. So how does this payment look in practice? In this case, Nicole has been stood down from work as there is no useful work for her to do. The employee will receive the $1,500 JobKeeper payment, of which the appropriate tax is $192, which will be withheld. The employee is therefore paid $1,308, and there is no obligation to pay superannuation. What if my employee ordinarily earns less than the JobKeeper payment? If your employee's normal wage before tax is less than this amount, the business must pass on the full $1,500 before tax. You will also need to pay the normal superannuation guarantee amount based on your employee's pre-JobKeeper wage. In scenarios where you may have a part-time or casual employee, you cannot require that the employee work additional hours to meet the $1,500 payment. Let's go through an example. Your receptionist, Ben, earns $1,200 per fortnight before tax. You will be required to pay Ben the additional $300 per fortnight before tax, totaling $1,500 per fortnight before tax. You have the option to pay superannuation on the additional $300, but are not required to do so. So in the example of Ben, if we look at the figures, the employer pays Ben $1,500, which is his normal wage of $1,200 plus $300 for the JobKeeper payment. The appropriate tax is $192, which will have to be withheld. Therefore, Ben is paid $1,308. The employee is required to pay superannuation on Ben's ordinary wages of $1,200, being $114. So what about if you've terminated your employees? What should you do? Well, some businesses may have terminated their employees before the JobKeeper payments were announced. If your business is still operating and you have employees that were employed at 1 March, you could consider rehiring those employees under the same, similar or different employment arrangements. For example, you may wish to rehire a previously full-time carpenter on a part-time basis or some other basis in accordance with what's called a JobKeeper enabling direction. Information on these directions is detailed in HIA's fact sheets and upcoming webinars. However, any rehiring of terminated employees must be done with caution. Be aware that employees who have been terminated may be seeking or receiving the job seeker payment. If the employee is rehired, these payments could cease and the employee would receive only the JobKeeper payment through your business. Also, once rehired, all applicable entitlements will accrue and will be available to the employee, for example, annual leave and personal leave. You will also need to make superannuation payments based on the employee's normal weekly wage arrangement. Also, if you have made an employee redundant, a decision to rehire that employee starts the employment relationship anew. Therefore, you cannot ask that your employee return any redundancy payments or other payments relating to the ending of that employment. What about if you receive an overpayment of the JobKeeper amount? If you receive an overpayment, you will be required to repay it. A general interest charge may also be charged from the date that the overpayment occurred. This, however, will be at the discretion of the ATO, and they may waive that amount if the circumstances involve an honest mistake where there was no personal benefit. So what next? As mentioned earlier, HIA has developed a series of fact sheets and webinars on the JobKeeper payment to assist members understand these requirements. We will shortly have other webinars available on making changes to working arrangements and record keeping and reporting obligations. As mentioned at the outset, this process can be complex and members requiring assistance can contact HIA's Workplace Services team by calling 1300 650 620 or emailing inquiry@hia.com.au. Thank you.